every trading book, every YouTube video, and almost every trading course teaches support and resistance the same way. Support is where buyers come in. Resistance is where sellers come in. Simple, easy to remember. But let me ask you something. Have you ever stopped and asked yourself, why? Why should buyers suddenly appear at exactly the same price? Why does a stock bounce from a level it touched weeks ago? Why does Bitcoin react to a price that millions of traders are watching? Is it just a coincidence? Or is there something deeper happening beneath every candlestick? Because here's the truth. Most traders know how to draw support and resistance. Very few understand why they exist. And if you don't understand why they exist, it's almost impossible to know when they'll work and when they'll fail. Think back to one of your own trades. Maybe you've experienced something like this. You buy a stock. At first, everything looks fine. Then price starts falling. 5%, 10%, maybe even more. Every day you open your trading app hoping to see green. Every small bounce gives you hope. Every red candle makes you wonder if you made a mistake. Then finally, after days or even weeks, price climbs back to exactly where you bought it. Now be honest. What are you thinking at that moment? For many retail traders, the thought isn't, great, now I can make money. It's something much simpler. I just want my money back. So you sell. Not because your analysis changed, not because the business suddenly became expensive. You sell because the emotional pain finally disappears. And then, almost unbelievably, the stock continues moving higher without you. If you've ever experienced that, you're definitely not alone. In fact, I'd love to know. Type "been there" in the comments if you've ever sold at break-even, only to watch price continue without you. Now, let's look at a completely different situation. Imagine you never bought the stock at all. You watched it rally from a distance. You wanted to buy, but you kept waiting. Maybe you wanted a better entry. Maybe you wanted more confirmation. Maybe you thought, I'll buy it after a small pullback. But the pullback never came. The market kept moving higher. And all you could do was watch. As price climbed, one thought kept repeating in your mind. If it ever comes back, I'm buying. Have you ever felt that? Most traders have. Now here's something interesting. Those two traders had completely different experiences. One lost confidence, the other missed an opportunity. Different emotions, different stories, yet both are now watching exactly the same price. Why? Because they both remember it. And that's the first idea I want you to remember today. The market doesn't remember prices. People do. Charts don't have memory. Candlesticks don't have emotions. Support lines don't have magical powers. People are the ones who remember. People remember the trade that made them money. People remember the trade that cost them money. People remember the opportunity they missed. People remember the moment they sold too early. And when enough traders remember the same price, something remarkable begins to happen. Their future decisions start to overlap. This is where support and resistance begin. Not with lines, not with indicators, not with chart patterns, but with memory. Think about your own life for a moment. There are probably places you remember instantly. A restaurant where you had an amazing meal, a road where you had a car accident, the school you attended as a child. Why do you remember those places? Not because they're physically different from thousands of other places. You remember them because something meaningful happened there. The same thing happens in financial markets. Most prices are forgotten, but some prices become unforgettable. Not because the number itself is special, but because something emotional happened there. Maybe thousands of traders made money. Maybe thousands lost money. Maybe thousands missed the move. Maybe thousands promised themselves, if price ever comes back here, I'm doing things differently this time. Now imagine millions of traders around the world carrying those memories. Some are professionals, some are beginners, some are investing for retirement. Others are trading full-time, different backgrounds, different strategies, different goals. But many of them remember exactly the same price. And when price eventually returns, those memories begin turning into decisions. That's the part most trading books never explain. Price creates experiences. Experiences create memories. Memories influence future decisions. And when enough people make similar decisions, support and resistance appear on the chart. Notice something. Support and resistance aren't created by the chart. They're created by people reacting to the chart. That's a huge difference. Because once you understand that, you stop asking, where should I draw my lines? Instead, you begin asking a much better question. What are traders remembering at this price? And that single question changes everything. Because if we know what traders are likely to remember, we can begin to understand what they're likely to do next. So now that we know memories matter, the next question becomes even more interesting. How does one remembered price suddenly become a level where thousands of traders decide to buy at the same time? The answer is surprisingly simple. Support isn't created because someone drew a horizontal line on a chart. Support is created because thousands of traders arrive at the same decision for completely different reasons. Let's see how that happens. Imagine a stock falls from $120 to $100. At $100, buyers step in. The selling slows down. The stock begins climbing again. Eventually, it reaches $130. To most traders, that looks like a normal bounce. But something much more important happened. Thousands of traders just created thousands of different memories. Let's look at the first one. Imagine you bought the stock at $100. Over the next few weeks, your trade worked perfectly. Your confidence grew. You trusted your analysis. You followed your plan. Most importantly, your brain connected one simple idea to that price. $100 was a good decision. Now imagine a few weeks later, the stock starts falling again. As price gets closer to $100, what are you thinking? Probably something like, it worked last time. Maybe it'll work again. Notice what just happened. You aren't buying because someone on YouTube called it support. You're buying because your own experience gave you confidence. Now let's look at someone else. This trader never bought the stock. Not because they didn't like it. They hesitated. Maybe they wanted confirmation. Maybe they thought the price would go lower. Maybe they simply froze. Then they watched the stock rally all the way to $130 without them. Every day they felt the same emotion, regret. Not because they lost money, because they missed an opportunity. Now imagine price starts falling back toward $100. Suddenly their thinking changes. This is my second chance. I'm not missing this move again. Again, buying pressure enters the market. Not because of technical analysis, because of regret. Now let's meet a third trader. This trader believed the stock would fall. They sold it short. At first, everything looked great. But then buyers appeared at $100. The stock reversed. Their profits disappeared. Some even started losing money. Weeks later, the stock begins falling back toward $100. This trader thinks, if price gets back there, I'm taking my profit and getting out. How do short sellers exit a trade? They buy. Once again, more buying pressure enters the market. Now step back for a moment. Three completely different traders, three completely different stories, three completely different emotions. One trader remembers success, one remembers regret, one remembers relief. Different memories, same action, buy. And when thousands of traders all over the world reach that same decision, support begins to form. This is why I want you to stop thinking of support as a line. Instead, think of it as a meeting place, a place where confidence, hope, regret, and profit-taking all meet together. Support isn't magic. Support is collective human behavior. Now let me ask you something. Have you ever looked at a chart and said, "Price has reached support. I'm buying immediately"? Be honest. How many times has that trade worked perfectly? And how many times did price continue falling? Stop you out, and then reverse exactly where you expected. If you've experienced that, type "too early" in the comments, because almost every trader has made that mistake at some point. Here's why. Most retail traders believe support is a signal. Professional traders don't. Professionals understand that support is simply an area where buyers might become active. Might is the important word. Support doesn't guarantee anything. It simply tells you where psychology may begin influencing decisions. Think about standing outside your favorite coffee shop. Every morning it's busy. People line up before work. Would you automatically assume there will always be a line? Of course not. Maybe it's a holiday. Maybe it's closed. Maybe people changed their routine. The location hasn't changed. The people have. Support works exactly the same way. The price level may be the same, but the people and their decisions can change. That's why some support levels hold beautifully, while others break without hesitation. Now let's turn the chart upside down. If support is created by buyers, what creates resistance? At first, the answer seems obvious. Sellers. But just like support, the real answer is much deeper than that. Resistance isn't simply where people decide to sell. It's where completely different traders, with completely different stories, arrive at the exact same decision. And once you understand those stories, you'll never look at resistance the same way again. Let's start with the first story. Imagine you bought a stock at $100. You believed in the company. You were excited. Maybe you even told yourself, "This is going to be a great trade." But the market had other plans. The stock dropped. $95, $90, $85. Every day you kept thinking, "I'll just wait. It'll come back." Days turned into weeks. Weeks turned into months. At some point, you stopped thinking about making money. You started thinking about escaping the trade. Finally, the stock begins recovering. $90, $95, $98, and eventually, it reaches $100 again. Now let me ask you something. What are most retail traders thinking at that exact moment? Not, "I'm buying more." Not, "This company is worth much more." They're thinking, "Thank goodness, I can finally get out." They sell. Not because they suddenly became bearish, but because relief is one of the strongest emotions in trading. That relief creates selling pressure. Now imagine thousands of traders who all bought near the same price. How many of them are thinking exactly the same thing? Probably a lot. And suddenly, resistance begins to appear. Now let's look at another story. This trader bought much earlier, maybe around $80. Now price has rallied all the way back to $100. They're already sitting on a healthy profit. Some traders continue holding. Others think, "I've made enough." No one ever went broke taking profits. So they sell. Again, selling pressure increases. Not because they were trapped, because they were successful. Different experience, same action. Sell. Now let's meet our third trader. This trader never owned the stock. They've been watching it climb. As price approaches $100, they notice something. Last time the market struggled here. Maybe history repeats itself. So they open a new short position. More selling enters the market. Now step back and look at the bigger picture. One trader sells because they're relieved. Another sells because they're protecting profits. Another sells because they expect the market to fall. Three completely different stories. One shared decision. Sell. And that's how resistance is created. Do you see the pattern? Support and resistance aren't created because everyone thinks the same way. They're created because people with completely different experiences often arrive at the same decision. That's why these levels can become so powerful. But here's the part that surprises most traders. Support and resistance don't last forever. Think about a wooden door. The first time you push against it, it barely moves. The second time, it's still strong. The third, the fourth, the fifth. Eventually, the hinges begin to weaken. Price levels behave in a similar way. Every time support is tested, some buyers disappear. Every time resistance is tested, some sellers are no longer there. The psychology changes. The crowd changes. The market changes. That's why a level that worked 5 times before may suddenly fail on the 6th attempt. Not because technical analysis stopped working, because people changed their decisions. And this is where many retail traders lose money. They see support, they buy immediately. They see resistance, they sell immediately, without asking the most important question. Are traders actually reacting here? Remember, support and resistance are locations. They are not entry signals. The reaction is the signal. Professional traders understand this. They don't predict. They observe. Retail traders often ask, will support hold? Professionals ask, what is the market doing at support? Retail traders ask, will resistance break? Professionals ask, who is winning the battle right now? That difference may sound small, but it completely changes the way you trade. Imagine two traders looking at the exact same chart. Both see the same support level. The first trader buys the moment price touches it. The second trader waits. They watch. They look for buyers stepping in. They notice volume increasing. They see the market rejecting lower prices. Only then do they enter. Which trader do you think has the higher probability of success? Patience doesn't guarantee profits, but it often improves your odds. And in trading, that's all we're ever trying to do. Improve the probability. Now here's something I'd like you to try the next time you open a chart. Before drawing a single support or resistance line, pause for a moment. Instead of asking, where are the lines? Ask yourself, who remembers this price? Who made money here? Who lost money here? Who regrets missing the move? Who is trapped? Who is waiting for another chance? Because if enough traders remember the same price, their next decision could become your next opportunity. That's exactly how professional traders think. They don't just read charts. They read people, and that's why support and resistance become far more than horizontal lines. They become a map of crowd psychology. So before we finish, let me leave you with a simple framework you can use every time you analyze a chart. First, identify the important price levels. Not every little swing. Only the levels where the market made meaningful decisions. Second, ask yourself, who remembers this price? Third, wait. Don't predict. Observe. Watch how buyers and sellers behave when price returns. Fourth, always consider the bigger picture. Is the overall trend moving higher or lower? Support and resistance are much more reliable when they align with the broader trend. And finally, stay flexible. Sometimes support will fail. Sometimes resistance will break. That's not a flaw in technical analysis. It's simply the market reminding us that human psychology is constantly changing. I'd like to leave you with one final thought. The next time you open a chart, don't ask two stories. The story shown on the chart and the story remembered by millions of traders. When you learn to read both stories, you stop memorizing patterns and start understanding markets. And that is when support and resistance stop being lines and start becoming one of the most powerful psychological tools in trading. If this video changed the way you think about support and resistance, let me know in the comments. Today's classroom question: have you ever been stopped out at support or sold at resistance, only to watch the market move exactly where you expected afterward? Share your story below. Not only will I read every comment, but your experience might help another trader avoid making the same mistake. Until next time, keep learning, keep improving, and remember, the market doesn't move because it remembers prices. The market moves because millions of people act on the memories those prices create.